You graduated at the top of your class. You read the books. You follow the news. You understand how markets work better than most people around you. And yet, somehow, your portfolio keeps underperforming. Not because you pick bad companies. Not because you got unlucky. Because of something happening inside your own brain. This is the thing nobody talks about when they teach you how to invest. The biggest threat to your financial future is not a market crash. It is not inflation. It is not a recession. It is you. More specifically, it is the way your brain was wired, millions of years before the stock market existed, to make decisions that feel right in the moment but cost you everything over time. The name for this is behavioral finance. And it will explain more about why you are not as wealthy as you should be than any bad stock pick ever could. In 1979, a psychologist named Daniel Kahneman, who would later win the Nobel Prize in economics, published a paper that changed how we understand human decision-making. He called it prospect theory. The core idea is straightforward and slightly terrifying. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. Losing $50 feels worse than gaining $50 feels good. That ratio, 2 to 1, is not an opinion. It is a measurable, documented, reproducible feature of the human brain. Kahneman called this loss aversion, and it sits at the center of almost every financial mistake smart people make. Here is what loss aversion looks like in practice. Imagine your portfolio drops 10%. That is not unusual. The market drops 10% or more in a given year roughly once every 2 years on average. But instead of holding steady, your brain interprets that drop as a threat. The same neural systems that once told your ancestors to run from a predator now tell you to sell your positions. To do something. To stop the pain. And so you sell. You lock in the loss. And then, because markets historically recover, the S&P 500 has recovered from every single bear market in its history, you watch helplessly as the portfolio you sold climbs back to where it was, and then higher. You took a temporary paper loss and turned it into a permanent one. That is loss aversion. And it costs the average investor far more than they realize. The research firm Dalbar conducts an annual study called the Quantitative Analysis of Investor Behavior. They have been running it since 1994. Year after year, it finds the same thing: the average equity fund investor consistently earns significantly less than the market index itself. In one recent study period, the S&P 500 returned about 10.7% annually. The average investor in those same funds earned about 5%. The funds did not underperform. The people in the funds underperformed. The gap came entirely from behavior: buying in late when prices were high, selling in panic when prices dropped, and then buying back in again after the recovery, at higher prices. The same cycle, repeated endlessly, powered by fear and the desperate need to avoid loss. But loss aversion is only one trap. There is another one, just as dangerous, that tends to hit smarter investors even harder. It is called recency bias. Recency bias is the brain's tendency to assume that whatever just happened will continue to happen. If the market has been rising for 2 years, it feels like it will keep rising forever. If it has been falling for 3 months, it feels like the bottom might never come. This is not stupidity. It is a cognitive shortcut that once helped humans survive. If the river flooded last rainy season, assume it will flood again. That was good survival logic. It is terrible investing logic. Because markets do not move in straight lines. They are not predictable in the short term. And acting as if the recent past will simply repeat itself is a reliable way to buy high and sell low, the exact opposite of what makes money. The dot-com bubble of the late 1990s is one of the most documented examples of recency bias at scale. Between 1995 and 2000, the Nasdaq Composite rose roughly 400%. Every year was better than the last. Millions of intelligent, educated people looked at that pattern and concluded it would continue. Technology companies with no revenue and no earnings were valued in the billions. People mortgaged homes to buy shares. It felt rational in the moment because recent experience confirmed it would keep going up. The Nasdaq then fell 78% from its peak. It did not recover to its 2000 high until 2015, 15 years later. Those who bought in at the peak because the recent trend felt permanent paid for it with a decade and a half of waiting. Recency bias did not disappear after the dot-com crash. It reappeared in 2006 and 2007, when years of rising home prices made it feel like real estate could only go up. It showed up again in late 2021, when investors who had only ever experienced a bull market treated speculative assets as guaranteed income. Recency bias is cyclical. Every generation encounters it in a new asset class, and every generation is convinced that this time is different. There is a third trap that does not get nearly enough attention. It is called the Disposition Effect, and it was formally documented by researchers Shefrin and Statman in 1985. Here is how it works. When you own a stock that has gone up in value, you are quick to sell it to lock in the gain, because gains feel good and you do not want to lose that feeling. When you own a stock that has gone down, you hold it, because selling would mean admitting the loss is real. You are doing the opposite of what you should be doing. You are cutting your winners short and letting your losers run. The stocks most likely to recover, your winners with strong fundamentals, you sell too soon. The stocks most likely to keep declining, the ones you cannot bring yourself to exit, you hold too long. It is a systematic, documented pattern. And it is driven entirely by emotion, not analysis. This is the reason many active investors consistently underperform a simple index fund that just holds everything and never reacts to any of it. The index fund has no emotions. It cannot feel the panic of a 10% drawdown. It cannot experience the rush of a hot stock. It just holds. Year after year. And the math compounds in the background, undisturbed, while the intelligent active investor churns their portfolio in response to feelings their brain insists are rational analysis. Let us make this concrete with real numbers. Imagine two investors, both 30 years old, both starting with $10,000, both adding $500 a month. Investor A sticks to a broad market index fund. They hold through every crash. They add money on schedule whether the market is up or down. Investor B is smarter, or at least believes they are. They shift in and out of positions based on the news cycle and market trends. They sell when it feels dangerous. They buy back in when it feels safe. Over 30 years, at a historical average return of roughly 10%, Investor A ends up with approximately $1.1 million. Investor B, underperforming by just 3 percentage points per year due to behavioral drag, ends up with around $560,000. Same income. Same starting capital. A difference of over $500,000. The gap was not market timing skill. It was the cost of being human. Warren Buffett has described the ideal holding period for a stock as forever. That is not a quip. It is a behavioral strategy. Buffett understands that the hardest part of investing is not picking the right companies. It is staying invested in them when everything around you says to panic and sell. His most famous holding, Coca-Cola, was purchased in 1988 and has never been sold. Through crashes, recessions, global crises, and generational disruptions, the position held. The returns compounded. The behavior was controlled. The wealth accumulated. The solution to behavioral traps is not to simply try harder to resist your emotions. That does not work. The brain will always find a way to justify the emotional decision with a rational-sounding story. The real solution is to design your financial life so that your emotions have fewer opportunities to interfere. Automate your investing, set it up so money moves into your index funds on the same day every month, regardless of what the market is doing. Remove the option to react. If you must check your portfolio, restrict yourself to once a quarter, not once a day. Research consistently shows that investors who check their portfolios daily make more trades and earn less money than those who check infrequently. The information itself is not the problem, the reaction to it is. Consider whether you need to be in individual stocks at all. If the only reason you pick individual stocks is the feeling that your analysis gives you an edge over the market, you may want to examine Kahneman's research more closely. Studies show that even professional fund managers, with full-time research teams, proprietary data, and decades of experience, fail to beat a simple index fund consistently over 10-year periods. The percentage of actively managed large-cap funds that outperform their benchmark index over any given 15-year period is typically below 15%. The other 85% would have done better doing nothing. That is not an argument against engagement. It is an argument for humility, and for designing a strategy that removes your emotions from the equation wherever possible. You were not born to be a good investor. You were born to survive. To detect threats. To act fast when danger appears and to avoid pain at all costs. For most of human history, that wiring kept your ancestors alive. In modern financial markets, those same instincts are quietly, reliably, and consistently working against you. The market does not care about your feelings. It does not reward panic or bravery or intelligence. It rewards patience. It rewards consistency. It rewards the boring, automatic, never-watch-the-news strategy that your brain finds unbearable. You started by reading the books. You followed the news. You understood the markets better than most people around you. And the trap was never about knowledge. It was about the gap between knowing what to do and feeling able to do it when the market drops 10% and every headline says this time is different. Now you know what to call that gap. It has a name. And knowing its name is the first step to making sure it stops costing you money.